Good morning. Hey guys, this is Harry Pearson with One Ascent, of course, and we have got a real treat today. A dear friend and one of the folks that God has used to impact my life greatly is going to be speaking today. Jason Myhre with Eventide Asset Management, and he's going to be focusing on timeless truths for investing. As you guys know, we're part of a group called Kingdom Advisors, and Mr. Ron Blue loves to remind us that God's Word is always right, it's always relevant, and it's never going to change. And I think that in the chaos that is ensuing with this coronavirus, it's good for us to be reminded that God's Word gives us principles to live by, and it's always right, always relevant, and never going to change. And so just a quick story. About 7, maybe 8 years ago, we had heard about something called biblically responsible investing and really didn't care much about the message as it was being shared with me. It was kind of a make sure you don't focus on this and make sure you do this and avoid that. And God brought Eventide and Jason Myhre to us to give us a presentation that reminded us who is the owner of all things. And if God is the owner of all things, that simply makes us the stewards. And as stewards, shouldn't we at least consider aligning His assets with His principles and with companies that bless people instead of cause harm? And so when it was put that way to us that day, the question never again was what's biblically responsible, which I'm not even sure that's actually a thing. But the question instead became, who is the owner? And if He is the owner, that makes us the steward. So this is going to be an academic but also heartfelt look at timeless truths for investing. And so with that, I want to introduce my dear friend, Jason Myhre. And Jason, thank you for being with us this morning, buddy.
Yeah, it's a privilege. Thanks for having me.
And I'm gonna pray real quick for us, and I'm gonna turn it over to you if that's okay.
Sounds great.
Father God, thank you so much for this day. Thank you for the reminder that you raise the sun up every morning. And in the midst of this panic and the chaos that has ensued with the coronavirus, I think what you've reminded me and most of us, you've reminded us just how fragile and how dependent we are. And yet, in that fragile state and in that dependent state, you continually, consistently do your part and play your role of raising the sun, giving life, giving us air and oxygen to breathe and have life. And you are still on the throne and still in control. And we thank you for the positive news that we've had, that the curve is beginning to bend. We pray, Father, that you just continue to limit the deaths from occurring, allow the economy and the jobs to get back to where we were. But when we get back to where we were, help us to not forget the principles and the simple fact that you are the only one in control. And we are dependent on you, and you are a good Father all the time. And so thank you for our time today. We pray that you speak through Jason in a powerful way, and we love you in Jesus' name. Amen. Jason, take it away, buddy.
All right. Thanks so much. Really appreciate the introduction. Well, hello, everyone. It's really good to be with you this morning. And as Harry said, I'm going to be talking to you about these classic lessons in investing, or these timeless truths for investing. And I'll give you a little bit of an introduction about myself. So my name is Jason Myhre, and I'm a managing partner of a mutual fund company called Eventide. We're based in Boston. And as Harry mentioned, we have this Christian faith-based approach to investing, or values-based approach to investing is how we typically describe it. My day-to-day work is in an area we call advocacy, which I understand sounds very vague. What I'm advocating for is really the application of our values, beliefs, and commitments to our investment decisions, and not just making those decisions on the basis of profit alone. I'll touch a little bit on that at the end of today's presentation. With that, we'll go ahead and get started. So I'm going to set the stage here for us. None of this is going to come as a surprise to you. We've been living in a very strange world where this virus has been impacting the entire globe. The US has become the epicenter of the virus, with a very scary rise in the number of new cases. As Harry prayed, we are beginning to see this curve abate somewhat, and so hopefully we're beginning to see some light at the end of the tunnel. But as this has been making its rounds, we all know that this has affected the economy, including whole industries that have been brought to a halt, and this has, of course, upset the stock market. When all of this began, the stock market experienced its, believe it or not, its fastest decline in history. Not the deepest downfall, but the fastest. And then we reached what hopefully is the true bottom of this market sell-off. And then off of that bottom, the first week off that bottom, it was actually the fastest gain since the 1930s. So it's been a lot of turbulence in the market. Some of you that follow investing news know that the New York Stock Exchange on several days blew the breakers because of all the trading activity. And so it's been a very volatile time. And there's plenty for us to worry about in this time. And I know not top of the list is our finances, but we do have our investments to think about. And so this presentation is hopefully to help us to think about our long-term financial plan and how to think about investing in times like these. And rather than survey the twists and turns in this virus and its impacts on the economy and the markets, I actually think this is a great time to remember some of these timeless truths for investing, the collected wisdom that we have from almost 150 years of investing. And I've crystallized my points into 5. I'll put them up on the screen here and we'll walk through them one by one. The first is keep your eye on the owner, not the dog. Number 2, restrain yourself. Number 3, employ a system that forces you to buy low. Number 4, remember the most powerful force in the universe. And number 5, invest in businesses, not stocks. All right, we'll kick it off with this first one. Keep your eye on the owner, not the dog. Now, what do I mean by this cryptic phrase? Well, it comes from what I think is my favorite quote on investing, which was said by this person, Ralph Wenger, who was a very successful fund manager. He managed the Acorn Fund, which had a very successful track record. Ralph Wenger once explained how markets work. And this is as recalled by a person named Bill Bernstein in one of his books on investing. And the quote goes like this: he likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. The dog's owner is walking from Columbus Circle through Central Park to the Metropolitan Museum. At any one moment, there is no predicting which way the pooch will lurch. But in the long run, you know he's heading northeast at an average speed of 3 miles per hour. What is astonishing is that almost all the market players, big and small, seem to have their eye on the dog and not the owner. Okay, so hopefully you're beginning to grab onto this metaphor here. I'm going to make it really plain to you on the following slide. So what we're looking at here on this chart is the entire history of stock investing in the US. I'll point out a couple of things here. So in 1926, which is right about here on the chart, that's when the S&P 500 began. Many of you will recognize the S&P 500. It's the most popular benchmark for measuring market performance. It's the performance of the 500 largest companies in the US. But we have records going back all the way to 1871, these books that contain the daily records of stock prices. And so what we're able to do with those records is we're able to reconstruct the history of the S&P 500 prior to its inception, just to get a sense for how the market has performed using one frame of reference throughout this 149-year history. And then we're doing a couple things with the data in order to look at it properly. Number one, we are adjusting it for inflation as inflation has changed over time. This allows us to get what's called the real return. And then we're taking the dividends that these companies produce and we're reinvesting those dividends, because dividends are an important part of what's called the total return. So this is I think the best way to look at the stock market in its entirety. And if we kind of just step back from the screen and take a look at this, look at the remarkably consistent experience that investing has given us for 149 years. So the blue line represents the market in all of its ups and downs. And that, in a metaphor, was the dog on the long leash in New York City, darting randomly in every direction. We don't know what direction the market is going to go at any one moment. The yellow line represents the best fit line for the stock market performance. It's a straight line. There's absolutely no curvature to it. And you can see what a remarkable fit the yellow line is for the blue line. The yellow line is, of course, our owner, who's walking at 3 miles an hour northeast or up and to the right. If we actually look at the growth rate here, you can see it's been a constant 6.6% growth throughout that 149 years. And so while none of us know what the future is like, we've got a lot of history to provide us a sense of comfort in the resilience of American business and in stock investing in general. And I think our task is to not become overly concerned with where the dog is moving at any one point, but rather to keep our eyes on the owner, that yellow line. And you can see I've taken this up as close as I could to the present day in March, and our current crisis is but a blip on the map. All right, number two, restrain yourself. This is such an important point. I hope you can pay attention here. So I want to go back a little bit to introduce this point, to look at a Wall Street Journal article that came out, you can see here, December 31, 2009. So every decade, there is crowned a new king of mutual funds based on a ranking of 10-year performance. So whoever finishes at the top of the heap for 10-year returns, this is usually recognized by the papers. You can see during the decade of the 2000s, that best stock fund was a fund called the CGM Focus Fund. You can see the article, it says, meet the decade's best performing US diversified stock mutual fund, Ken Huebner's $3.7 billion CGM Focus Fund, which rose more than 18% annually, meaning 18% per year over that 10-year period, and outpaced its closest rival by more than 3 percentage points. So I'll remind you about what the 2000s were like. It was an awful decade for investing. It's called the lost decade in investing. Many consider it to be the worst 10-year period in investing history. The market experienced 2 very painful crashes during that time, including the crash of the financial system. And so the fact that this manager was able to gain 18% per year is really impressive. Now, what I want to do is I want to ask you a question, and to get your responses, I'm actually going to put a poll up on the screen, which you'll see. And it's coming at you right now. What I want you to respond to is, I want you to tell me what you think, what your guess would be as to the return that the investors in this fund got. So the fund got 18% per year. How did the average investor in that fund do per year? Did they get the full 18, or did they get something less? You can see the choices there on the screen. Great, I'm seeing the responses come in. You guys are figuring this out. This is awesome. Appreciate the participation here. All right, I'll leave this open for another moment so everybody gets their answer in. I'll be able to show you the results so we can see how savvy we are as a collective group. Okay, I'm gonna call it done in the poll and share the results with you. Okay, so no one thought that the average investor got the full 18% per year. 14% of you thought they got 12% per year. 36% of you thought they got 9%. The majority of you, 43%, thought they got 2%, and then 7% thought it was so bad they got negative 11%. Well, we'll look at the right response here. The article continues. Too bad investors weren't around to enjoy much of those gains. The typical CGM-focused shareholder lost 11% annually, meaning 11% per year, in the 10 years ending November 30, according to investment research firm Morningstar Inc. So the fund's up 18 a year. The investors in that very same fund are getting a negative 11% per year. How in the world is this possible? Well, they go on to explain. These investor returns, also known as dollar-weighted returns, incorporate the effect of cash flowing in and out of the fund as shareholders, and here's the key, buy and sell. Investor returns can be lower than mutual fund total returns because shareholders often buy a fund after it has had a strong run and sell as it hits the bottom. So here's what's going on. People are shopping for a mutual fund. They look at the best performing funds and they say, wow, look at the return on this one. And so they invest. And this is typically after a hot streak of performance. And so they're buying the fund when it's expensive. The fund then will undergo a downturn, as all investments have. And they'll give up. They'll say, this fund is a dog. I'm out of here. So they cash out at the bottom. So they bought high and sold low. Lo and behold, the fund recovers. They pile in again. It turns over. They ride it to the bottom and they cash out. They make all of the classic mistakes in investing. I would put this quote in probably the top 3 most well-known quotes on investing. This is a quote from Warren Buffett. Many of you will know his name. The quote reads, "Be fearful when others are greedy, and greedy when others are fearful." Now, let me say, I do not encourage anyone to operate their life out of a place of fear or greed. But nevertheless, there's a principle here in this quote that I think is really important. So he says, be fearful when others are greedy. In other words, when everyone's feeling greedy and piling into the stock market and telling their friends and family to get in stocks, well, we should watch out at those times because those typically mark times when the market is peaking at its top. And then he says, be greedy when others are fearful. So when others are fearful and they're panicking and they're cashing out and they're putting money under their mattress and feeling like the sky is falling and the world is coming to an end, those are actually the times when we should be looking to invest, right? Because those are times when the market is cheaper and is experiencing a bottom. Now, everyone loves to quote this quote. I have heard it so many times in my industry. But there is a world of difference between saying this quote and being the disciplined person that puts the wisdom here into practice. And it's very easy for us to point the finger at the mistakes of other investors and not to recognize those same tendencies that are resonant within us. This is a book on psychology written by an economist, a person named Daniel Kahneman. He actually won the Nobel Prize in economics. The book is called Thinking, Fast and Slow. This is a very popular book in my world. It's gotten passed around a lot. I'll save you the trouble of reading this book on psychology by just telling you what the premise of the book is. This comes from page 1. It says, the premise of this book is that it's easier to recognize other people's mistakes than your own. We have to recognize that we are not immune to these emotional decisions that can wreck our financial plan. I want to show you this. We're going to look in the mirror here a little bit. When we do, we find that we are often our own worst enemy. So what we're looking at in this chart, you can see here, are the 20-year annualized returns of various asset classes or investments. The period of time we're looking at is 1996 through 2015. You can see over that 20-year period, the best possible investment that you could have made was in something called real estate investment trusts. Those are investments in things like office parks. That returned 10.9% per year for 20 years. Next, you can see the performance of the S&P 500 at 8.2%, a 60-40 blend of stocks and bonds, a 40-60 blend of stocks and bonds, bonds themselves, gold. This is the performance of international stocks. This is the performance of homes, the performance of oil. You can see the rate of inflation. And look at this. The average investor underperformed every investment over this 20-year time period, failing even to keep up with the rate of inflation. This is just abysmal. Now, why? Why is this? How could this be? It is for the exact same reason that I showed you that the CGM focus shareholders underperformed the best investment they could have made in the 2000s. It doesn't really matter what the investment vehicle returns if we try to dance in and out of the market and try to time the market and outsmart our investments, we do so to our own financial peril. We have to restrain ourselves from making these decisions. I love this quote from Morgan Housel, who says that finance would be better if it was taught by the psychology and history departments at universities. I couldn't agree more. I showed you the history with the dog and the owner. We just talked about the psychology. Here's an old school legendary investor, Jesse Livermore, who says that the big money is not in the buying or the selling, but in the sitting. We have to restrain ourselves. Number 3, employ a system that forces you to buy low. Now, we all know this. When is the best time to invest? When prices are low. And so we should think about finding a system that will help us to do this consistently, to buy low. To introduce this point, I want to introduce you to an experiment. This is going to be another opportunity for you to interact. So I'd ask you to pay attention here so you can be involved. The experiment is this. Let's all imagine together that we were placed into history somewhere between the year 1920 and 1979. So we could be, airdropped into 1945, 1963, etc. And our task is that we have to invest in the US stock market for the next 40 years. Okay? I'm going to give you a choice of 2 strategies. Option 1, you can invest $100 a month. Option 2, you can save up that $100 a month, keeping cash on the sidelines, and try to buy the dips in the market. So whenever the market crashes, you try to time it to where you can buy the market bottom. So you're purchasing at the most optimal low prices. Now, I'm going to sweeten the deal on option number 2. I'm also going to grant you perfect knowledge of the future so that you will be guaranteed to buy the market at its absolute bottom. Question is, which would you choose? I'm going to fire off another poll here. All right, coming at you. So option 1, you can invest $100 a month. Option 2, you can save up that $100 a month, keeping cash on the sidelines and buy the dips in the market, keeping in mind that when these dips will take place. What do you choose? Awesome. Thanks for participating. Whenever you do these webinars as a presenter, you're kind of just speaking out into the void. And so it's really nice to at least see some numbers coming back to you on the screen. So thanks for doing that for me. Okay, any last call? Okay, I'm going to end the poll and share the result. Okay, so here's what you said. 67%, the majority of you said you would choose option 1, investing $100 a month. 33% of you said that you would choose option number 2, the buy the dips strategy. Well, someone actually performed this experiment. They looked at every possible scenario. For example, if you were dropped into the 20s, which one would have been the better choice? They played out both strategies for the next 40 years and did all that math. And so we actually know what the results would be and what the best choice would be. So I'm going to show that to you. You can see here, I'll tell you how to read this. So if this blue line is above the dotted line, that means that the buy the dip strategy was the better choice. That would be option 2. When the blue line goes below the dotted line, that means that option 1, investing $100 a month, would have been the better choice. So you can see that in the 1920s, the buy the dip strategy would have been the best choice. And again, in the late 30s, early 40s, the buy the dip strategy was the superior choice. But look at how much time the blue line spends below the dotted line. In other words, look at the amount of time that boring, regular monthly investment outperforms. In fact, it's 70% of the time. So 70% of the time, this boring strategy is outperforming. Now, with option 2, the buy the dip, remember that I granted you perfect knowledge of the future, which of course none of us have. I don't have a poll on this, but for example, do we believe that the true market bottom of the coronavirus market sell-off has taken place? I don't know. I'm guessing that you don't know either. And if we happen to get these timing bets off by just 2 months, if we miss time buying the dips by 2 months, which is really easy to do, then The boring monthly investment strategy outperforms 97% of the time. Now, how can this be? What is the magic at play here? I want to show this to you. The magic is called dollar cost averaging. It's very, very simple. It's the practice of investing a fixed amount of money at regular intervals over time. So $100 a month, perfect example. I'm going to show you on charts why this works, but I'll give you the explanation here. When we invest a fixed amount of money at regular intervals over time, a couple things are happening. This strategy will naturally buy more shares when investment prices are low. So you're investing a fixed amount of money, prices happen to be low at that time, well, your money's going to go farther. And it will naturally purchase less shares when prices are high. Fixed amount of money, prices are high, your money doesn't go as far. I want to show this to you. We're going to look at the lost decade in investing, that period of the 2000s I described earlier. You can see those two painful market crashes. This was the financial crisis. The S&P 500 for the entire decade was down 24%, which is pretty depressing. So how did dollar cost averaging work in this time period? So same chart I just showed you in the blue, that's at the top. On the bottom, this green line shows you the number of shares that you're able to purchase through a dollar cost averaging program. You can see here when the market was peaking, your fixed amount of money that you were investing that month didn't go as far. So you were only able to purchase, in this case, 3.5 shares. The market crashes, so your money starts to go farther. The market rallies, your money starts to not go as far. The market crashes, you're able to purchase more shares, and so on. Now, if we kind of just step back and look at this chart, do you notice something? Do you notice that dollar cost averaging is actually peaking when the market is at its absolute bottom? And so dollar cost averaging is in fact a buy the dip strategy when you do not have perfect knowledge of the future. And it's smart buying. So dollar cost averaging is able to purchase nearly twice as many shares when prices are lower than when they're higher. So you're purchasing at in a very smart way. And just because of this smart purchase strategy, your performance over that 10-year period through dollar cost averaging would have been positive 5.9%. So not great, right? But a whole lot better than negative 24%. Now, there's one other reason why dollar cost averaging is superior to buying the dips. And for that, I'm going to issue my last and final poll. Okay, it's coming at you. I need to explain this one to you. So please, no cheating on this one. I know you guys are connected to the internet here. What I want you to tell me is your recollection of the US stock market performance last year in 2019. So it's in the history books. How did stocks do? Were stocks down? Were they flat? Or were they up? If they were up, how much do you think they were up? 10, 20, 30, 40, or 50%? What do you think? Last year's stock market performance. Great. Thank you. We'll see how closely you guys pay attention to the stock market. All right, we got a good group here. And I'm going to end the poll, share the result. Okay, so a few of you believed that stocks decreased. A few of you thought they stayed the same. 13% of you believed they increased but weren't sure how much. 20% of you thought they were up 20. 27% of you thought they were up 30. Correct answer was 30. The stock market was up about 33% last year, so 27% of you got that right. And you actually fared better than the average American. So congratulations to Pearson and Associates for helping your clients to be aware of what's going on in the world of investing. I copied my poll directly from what is a common poll that is done by the leading polling agencies. You can see I chose Gallup here to illustrate. We're looking at mid-2014, asking the American public about the prior year, 2013, average stock gains. I copied the survey word for word, only swapping out the dates. This is a survey that has been repeated year after year after year. You can see that less than 7% of the American public actually was aware of how well the stock market did in this particular example. The market was up 30% in 2013. Only 7% of the American public knew that or were aware of that. And as I said, this has been repeated over and over and over again. When we look at all these surveys in totality, what we find is that people are very aware when markets crash, but they are very unaware when markets are rising, okay? So we have this asymmetric awareness that is skewed towards thinking things are worse than they are in reality. Now, I think there's a couple of reasons for this. Number one, I think we tend to worry a lot. Number two, I think that this comes from how we receive our news. So in the newspaper industry, maybe you've heard the famous quote, "If it bleeds, it leads." Okay, so in order for something to be the lead story in a newspaper, something needs to be bleeding, right? Somebody needs to be injured. There needs to be some catastrophe in order for it to make the news. So the news is often bad news. And I think it gets us accustomed to thinking that things are often worse than they really are. In fact, I saw a 25-year collection of survey data like this, where for 25 years in a row, the American public thought that the economy was in decline. 25 years in a row, it's remarkable. So the reason that dollar cost averaging is superior to buy the dips, it's not only that it is buying the dips, it's that it gets you into the market, and the market is often rising. Here's a quote: "While you wait for the next dip, the market is likely to keep rising and leave you behind." This is a very unlikely person to quote in an investing presentation. This is Napoleon Bonaparte. This was his definition for military genius. I think this applies equally to investing genius. He says it's the man who can do the average thing when all those around him are going crazy. Let me tell you something about dollar cost averaging. You're not going to impress your friends. You're not going to be interesting dinner company. No one is going to think that you are savvy or sophisticated. You will have friends that have some newfangled investment strategy for how they can outsmart the stock market and time it or do all of these crazy things. And don't listen to them. Your boring average plugging away like clockwork every month is going to be, for the most part, as we saw, 97% of the time, the superior strategy. All right, number 4, remember the most powerful force in the universe. Believe it or not, Albert Einstein once said this: "The most powerful force in the universe is compound interest." Compound interest. Think about the contributions of Einstein to the sciences, right? This person is very attuned to the natural laws that govern our universe, and he's saying that the most impressive force that he has found is compound interest. What has him so impressed here, and what is compound interest? I'm going to illustrate it using a classic example in investing. It's called a very expensive cup of coffee. So coffee in the US is about $3. And if instead of buying a cup of coffee at $3 a day, we were to invest that $3 a day into stocks, how much would we have after 40 years? Well, if we assume the historical growth rate from the dog and the owner of 6.6%, after 40 years, we'd have a little more than $210,000. You know, not eye-popping, but hey, we're only socking away $3 a day. So how does this work? I want to explain compound interest. What is compound interest? I think when you often look at definitions online, they tend to be pretty technical and I think a little wonky, and you don't really get much out of it. I like this simpler definition from Benjamin Franklin. Yes, that Benjamin Franklin. He says that compound interest is when your money makes money, and then the money that made money starts to make money. I know this is a little vague right now. I'm gonna show it to you though. It'll become perfectly clear here in a minute. Let's look at the math on our coffee problem. So $3 a day times 365 days, that's $1,095 for a year. That's how much you're investing. If we invest that $1,095 and it grows by the historical growth rate of 6.6%, well, after 1 year, we would have $1,167.27. In year 2, compound interest kicks in. So we invest another $1,095 saving on coffee. That gets added to what we had already, which was the $1,167.27. That gives you $2,162.27. And then that amount is growing again by 6.6%. And leaving us with a total of $2,411.58. And this process repeats. It starts out very humble, but begins to really snowball over time. So if we look at Benjamin Franklin's definition, we can see that it's when our money starts to make money, and then even the money that made money starts to make money, okay? So the interest that we gained on our investment, that interest is reinvested, and then we make interest on that interest. That's where we get the term compounded interest. This is what it looks like on a graph. So $3 a day in coffee over 40 years is 43K. You can see that that's where we get the more than 210,000 with compound interest. Look at the upward sloping line here. The longer you let this go, the steeper that curve gets. It is actually approaching a vertical horizon. And you can see what this would look like if we chose an example that's more relevant to us. What if we maxed out our IRA each year, right? So this year's contribution limit is $6,000. And if we did that for 40 years, that would be $240,000 invested. This is very possible for most of us if we think about careful life and financial planning. After 40 years, it grows to more than 1.1 million. And this is just through the power of compound interest. I want to give you a neat story on Benjamin Franklin. As I said, he was pretty impressed with compound interest. To prove it, when he passed away, he gave a very small gift to 2 cities in the US. He gave $5,000 to Boston and $5,000 to Philadelphia. He put that $5,000 into investment accounts, and he told the cities that they weren't allowed to touch it for 200 years. So look at how steep this curve is at 40 years. Imagine it at 200. Well, that 5,000, as you can imagine, grew to a lot of money, tens of millions of dollars. And the cities of Boston and Philadelphia are still trying to spend that money. Neat story. The reason all this works, of course, is that time is on my side. Yes, it is. These are legendary investors, the Rolling Stones. Another quote from Warren Buffett: "The stock market is a device for transferring money from the impatient to the patient. Be patient. Let time do its thing." All right, number 5, last point, and I think the most important. Invest in businesses, not stocks. Okay, so one of the convictions I have at my company, Eventide, is that by and large, we have lost sight of what we're doing in investing. We've lost sight of the true purpose of investing. Investing has really been divorced from its original and most basic idea and purpose, which is simply to invest in businesses and to partner with businesses over the long term, to buy companies that we believe in and are excited about. You might say, well, that's odd. Why would you make that statement? You know, many investors today, instead of thinking about businesses, what they're trying to do is profit from the market itself. Okay, so the market is the collection of all these businesses. They're not so interested in being selective about the kinds of companies they own for any reason. They say, let me just own it all. And so they own the whole market. They don't really care about companies. And what happens when we embrace that view of investing? Well, what we're left with is a relationship that really just is reduced to a performance-only relationship. And let me tell you something, it's going to be a very rocky relationship, right? When the market's doing great, we're going to feel great. When the market crashes, we're going to panic and we're going to lose our peace of mind. This is a professor from DePaul University who is describing what it feels like to be an investor. Try this on for size. He says, retirement accounts tend to go into mutual funds, where as an investor, not only do I not have any idea how the companies I have stock in are being operated, I don't even know what companies I have stock in. And these investments are run by an elite of managers whose one preoccupation is with increasing the bottom line. Maybe you've had this feeling when looking at an account statement and saying, well, I like the positive number I'm seeing here, but where's it coming from? Where are these profits coming from? what kind of companies do I own? Do I believe in these companies? And are these companies that reflect my beliefs, values, and commitments? I want to give you a window into what it's like on the investment manager side. This is from a person named Cliff Asness. He's a very celebrated hedge fund manager. And I heard him speak at an investing conference a few years ago where he made this astonishing statement. He said, "I pride myself on not knowing what's in our portfolios." So think about this. This is the fund manager who is picking companies on behalf of his investors. And this fund manager is saying that he doesn't even know what's in the portfolio. And he even considers it a point of pride. Now, why is this? Because he's driven by the numbers, right? He lets the numbers do the deciding, and he doesn't want to be bothered by knowing what these numbers, what companies they're coming from. If he knows that it's, let's say, Google, that the numbers are attached to, that might cloud his judgment. And so people are really impressed with this line of thinking. And I remember looking around the room when the statement was made to see how it was registering on the faces of the audience. I could see a lot of admiration. This is celebrated today. I actually think this is a loss. I think this is something we should lament. I think we really need to remember that when we invest, we're going to own companies. This is, of course, why we get the rights to any of the profits and growth. It's why anyone invests in the first place. But I think we should think about this from a values perspective as well. We need to understand that those profits will be flowing from the activities, products, and services of companies. And do we feel good about the returns that we're receiving? I think we need to engage our values in this investment decision-making process. Since investing is company ownership, I want to suggest some ownership questions. So we could have questions, for example, about the management team at these companies. We could have questions about the company's relationship to its customers, its employees, its suppliers, the communities in which it's based, the natural environment, even society broadly. Here are some questions we could ask ourselves. Would we want to work under that leadership team? How likely would we be to recommend their product or service to a friend or loved one? Would we want our son or daughter to work at this company? On a scale of 1 to 10, where 1 is a new flavor of gum, 10 is a cure for cancer, how much value does the company's product bring to humankind? By the way, this could be negative, such as in the case of companies whose products harm their customers or even destroy life. If we were to walk into a supply center, would we be proud of the quality and working conditions that we observe? What would our reaction be if the company opened an office in our neighborhood, opened a supply center, plant, or factory? And does this company's environmental policy and actions leave a better planet for our grandchildren? These are company ownership questions, right? And I think they get to the heart of what investing is all about. If we can answer these questions well about the companies in which we invest, I think the rest of investing becomes much more straightforward. And very importantly, we can gain peace of mind. This is the last quote. I know this is a lot of text here, but I love this quote. This is from our Chief Investment Officer, Finney Curvella. Many of you have had a chance to listen to him. I know that you guys had a call recently with him. He's talking about how you can gain peace of mind. And the quote goes like this: "By investing with Eventide, you will grow in your peace of mind." How do you get it? Peace of mind is the byproduct of trust, and trust is the byproduct of knowledge. Many people have had the experience of purchasing a stock, becoming nervous as it declined, and then selling out at a loss, perhaps only to see it go right back up. On the other hand, if a person knows the business the stock represents, trusts management, and so comes to believe in the company, these declines are not so troubling. That person is a confident investor because history has shown that great businesses not only endure downturns, but emerge even stronger, making these declines attractive points to invest further. At Eventide, we help investors understand the merits of our portfolio companies so they can better appreciate what they own and thus transcend a mere chart-based financial relationship. Eventide investors can then have greater confidence and less stress because they're not buying mere paper or a derivative, but a portfolio of quality businesses they know and trust. After all, life should not be spent staring at a computer screen, watching ticker gyrations, but instead free from needless stress. At Eventide, we strive to help give you that peace so you can spend your time on what matters most. The most enduring and lasting sense of peace of mind comes from having confidence and a deep sense of resonance and alignment with the companies in which you invest. So I would encourage you to think about it in that way. Here are the timeless truths of investing. Keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe, and invest in businesses, not stocks. With that, I'm going to invite Harry back onto the call. And I believe we'll have a chance to take some questions. If you want to ask us a question, you'll see in your controls there something that says Q&A. If you click on that, you'll see that a text box will come up where you can type in a question. We'll be able to see it on our end, and we can answer any questions that you might have.
Good deal. Jason, thank you so much, brother. That was incredible. You are one of the most gifted teachers that I've gotten to listen to, so I really appreciate you. I think one of my big takeaways is that we won't be buying that $3 coffee anymore.
You know what? I'll find another $3. I want to hang on to that cup of coffee.
Well, yeah, and my wife probably doesn't appreciate that. She's not going to buy that $3 coffee either. So. But anyway, so thank you for that. I'm looking here to see if there's any questions. I don't see any questions at this time. This is our team of advisors, and that's a good-looking crew right there. I'm not sure that we would win any basketball games 5-on-5, but it's a good-looking group, and more important than that, they serve well, love folks well, and really value relationship and caring for people. So I'm not sure. Are there any other slides for us, Jason, or is that our last slide?
This is it. So we can hang on for a question. I'll say one thing. You know, when I give this presentation, it is sometimes with advisors where point number 5 doesn't have a solution. And it's exciting to me to get to give a presentation like this where that concept of intentionally choosing businesses that align with your beliefs, values, and commitments is something that you are practicing. So this is something that you guys can really take comfort in. You don't have to look at your account statement and have that back of the mind worry that some of the things that you're profiting from would be a misalignment with your life. In fact, you can have confidence to know that the companies you own not only are meeting a sort of baseline criteria for your values, but are actually positively expressing your values. You're owning companies whose products and services are meeting important needs in the world and that are creating a measure of blessing in the lives of others. So hats off to you, Harry, for, I would say, building a firm from the ground up and departing from some of the conventional broker dealers and financial advisors to really build a practice on values. I think that is just so awesome, and we love working with you guys.
Well, thank you again for those kind comments. Thank you for your thought leadership, and even those questions that you shared a second ago. You know, if buying stock in a company makes us an owner, which it does, then we need to process and think through the questions that you talked about. You know, would we want our son or daughter working for this company? Would we refer or recommend this product to one of our friends? All the different pieces and parts that you laid out. So, Jason, thank you for your time, brother. Thank you for your wisdom. And guys, thanks for attending the conference today, the webinar. God bless, and we'll see you soon.